Kevin Warsh can't raise rates because that would exacerbate the situation with Japan. So the Japanese situation is starting to have an impact on us because they own over $1 trillion of our debt. When you get into the world of what crypto is meant to represent, and you think about this interconnectedness of debt, it was never about the US. It's a global problem. And I think because we have a global bear market on the long end, and we need the financing of the AI trade to stay there, this was the first salvo of many, in my opinion, that we're going to have to figure out ways to get long-term yields down. And that means we're going to have to be easier with monetary policy and come up with some solutions. And once we get through the clarity overhang in the market and we actually get an answer, whether it's positive or negative, in my opinion, I think the debasement stuff and the decentralization theme starts to take over from AI going forward.
With the yen under enormous pressure, Japanese authorities have been forced to intervene, and for the first time in nearly 3 decades, Washington has stepped in alongside Tokyo. This is not simply a story about the yen. It is a warning about what happens when the world's biggest economies become so interconnected through debt that one country's bond and currency problems begin threatening the financial system of another. The recent U.S. Japan intervention was indeed historic, with Washington joining Tokyo in supporting the yen after it approached 164 yen per dollar. And according to macro investor Jordi Visser, this is where things get extremely interesting for markets. Because if Japan cannot allow its currency to keep weakening, while the United States cannot afford another disorderly rise in long-term treasury yields, policymakers are increasingly caught between competing pressures. They need to contain inflation, protect the bond market, support an enormous AI investment boom, and somehow prevent the global debt machine from becoming unstable. Visser's argument is that this intervention may be one of the first signals that policymakers will eventually have to find ways to push long-term yields lower and make financial conditions easier. And that could completely change the backdrop for risk assets. Bitcoin has spent much of this cycle struggling to deliver the explosive performance many investors expected, even as institutional adoption and the crypto infrastructure around it have expanded. But Visser believes the story could look very different once the AI-driven investment boom gives way to the next phase of the liquidity cycle. He sees a world where continued debt expansion, monetary easing, tokenization, and the gradual disruption of traditional assets could propel the entire crypto market from just a few $1 trillion today toward an extraordinary $100 trillion over the coming decade. So, what exactly did Washington and Tokyo just reveal about the global financial system? Why does Japan's debt problem potentially constrain U.S. monetary policy, and how could another era of expanding liquidity eventually transform Bitcoin and the entire crypto market? Visser connects all of these pieces and then takes the argument much further, explaining why AI could actually accelerate the shift toward a more decentralized financial system. If you enjoy deep dives into Bitcoin, macroeconomics, and the forces moving global markets, hit the like button, subscribe to the channel, and turn on post notifications so you don't miss the next analysis. And now, let's get into Visser's argument.
You have, on Friday night, for the first time since 1998, you have the BOJ and Scott Bessent, the Treasury, intervene in dollar-yen. And they do it in a nuanced way, and this is the reason why it's so important. Let's just start with, it was the first coordinated intervention by those two countries since 1998. 1998, it happened right around the time of LTCM. It happened at a very critical point, again, in innovation. That's when the internet bubble was being created and everything was going on, and the disruptive forces were happening fast. Basically, it was sucking in all of the money in the world into this place. Now, the reason this is so important is which country of the G7 has the largest debt to GDP? It's not the US, it's Japan. Japan has been on this train to whatever you want to call it, debasement hell, since I joined the world of Wall Street back in 1992. So you fast forward, almost 30 years from that time period there, and we do another coordinated effort. But what did they do? This is because the Japanese are selling US treasuries to deal with their own currency weakness. So everyone is always focused on the fact the dollar will eventually collapse. Luke Gromen has gone on and he's talked about the fact that either you have to have rates go down, but if rates are going up, you need the dollar to go down. If both of them are going up, you end up in this very big problem. Well, Japan has both of those problems. They have a bond bear market and they have their currency weakening. and they are the weakest of the bunch, meaning their debt to GDP is the highest. So unlike in 1998, where the US was at a very different stage, the entire world now has a debt to GDP of high levels. And so this was a situation where what the Fed and the Treasury involved had to do was, number one, the US sold euros to buy the yen. Okay. That is the first time they haven't, I mean, basically they're supposed to do dollars. On the other side, they allowed the Japanese to go into the repo market to borrow them, to basically go through and post their treasuries as opposed to selling them to get cash to then go in and buy their currency. So we're at a point where, from my perspective, this was a form or a way to do yield curve control in the US without doing it, because the reason Besant got involved is because 30-year treasury rates, again, were breaking through to higher new levels the same time that dollar yen was breaking to higher new levels. So this whole thing is aligned. And whether people see it or not, the markets are telling him, and we are at this point where what is AI doing? We need massive capital needs. So you have the CDS blowing out for all of these hyperscalers because they need trillions of dollars to build out AI. So the innovation has caused this issue with debt to GDP at a high level. Inflation is sticky because of AI, because we're not getting the deflationary part yet. We're getting the build out part, of which it's constrained by physics. So my point on this is we actually saw money printing last week. And here's the interesting part. If you read and listen to every person, this will not stop anything because this can't go on forever. They had to do more than $50 billion to move it only from 164 to where it is now, which is 158. We have a BOJ now hike potential in September at 50 basis points. The Fed is still listed as 60 basis point or 60% chance of going 25. So it kind of makes sense to me that if they're basically trying to intervene in the market, Kevin Warsh can't raise rates because that would exacerbate the situation with Japan. So the Japanese situation is starting to have an impact on us because they own over $1 trillion of our debt. So when you get into the world of what crypto is meant to represent, and you think about this interconnectedness of debt, it was never about the US. It's a global problem. And I think because we have a global bear market on the long end, and we need the financing of the AI trade to stay there, this was the first salvo of many, in my opinion, that we're going to have to figure out ways to get long-term yields down. And that means we're going to have to be easier with monetary policy and come up with some solutions. And I think that's why gold is having its biggest day in a while. I think that's why platinum broke out. I think it's why silver is breaking out. And once we get through the clarity overhang in the market and we actually get an answer, whether it's positive or negative, in my opinion, I think the debasement stuff and the decentralization theme starts to take over from AI going forward.
What makes Visser's argument so important is that he isn't treating the Japan intervention as an isolated currency event. He's connecting the yen, Japanese treasuries, U.S., long-term yields, and the AI capital boom into one giant liquidity equation. Japan is dealing with an enormous debt burden while simultaneously trying to defend a currency that has been under pressure. But because Japan is also one of the world's largest holders of U.S. government debt, its decisions can spill directly into the American bond market. And when long-term treasury yields rise at the same time that the yen weakens, policymakers suddenly have a much bigger problem to manage. That's also why Visser's discussion eventually moves beyond Japan and toward the monetary system itself. If governments cannot simply allow yields to rise indefinitely while economies are carrying historically high debt loads and while companies are demanding unprecedented amounts of capital for AI infrastructure, then something eventually has to give. And Visser believes the eventual answer could be easier monetary conditions, expanding liquidity, and another phase of monetary support. But if that happens, the question becomes, where does all that money go? That's where his $100 trillion crypto market thesis becomes particularly interesting.
You talked about a bit about the crypto market cap getting to 100 trillion. It was, it's, I don't know if it's like at 2 or something like that right now. How does that happen?
Well, it happens two ways. One is the printing overall continues because of AI and the debt is still there. So that doesn't stop. So that just comes down to assets. And when I did say that, someone asked me a question on do I have a price for Bitcoin? And I put it in a contextual side again and said, well, let's go through it this way. Currently, the fiat system is about $700 trillion and the crypto world is close to 3. In a decade, which is what I said, I believe that the fiat world at best is around the same size as it is, to slightly higher. And there's a variety of reasons for it. But because I believe that the agentic economy will continue, I think the disruption of stocks will continue. I think tokenization will release dormant assets and money will start looking for higher yielding or higher places where they're getting some positive return. I'm a believer that real estate, venture capital, private equity, public stocks, and I say public stocks, and I'll get back to this whole disruption. Everything that exists today to me is going to produce very little returns going forward over the next decade. For the next 3 years, stocks will be fine. But at some point when AGI gets here, all those things that I said were positive for an entrepreneur, they are negative for a public company. Public companies can't use open source. And I don't know how people don't get this. Maybe it's because they didn't work for one. I don't know if you ever worked for a Fortune 500 company, but anyone who's worked for a Fortune 500 company, the bureaucracy is out of control. To get something agreed at Morgan Stanley takes divisions and division heads and all the middle management. To hire someone, to fire someone takes forever. There is no way these companies are going to use open source because of the risks associated with it. If nothing else, they pay companies like an Anthropic and basically say, if there's a hacking issue, you guys are at risk. Like, they're indemnified. This is all part of business going forward. The biggest issue they have is people. So I'm a big believer that we've invested in a world based on people working in the system. Real estate. I don't get the fact that people don't see, okay, real estate changed on a commercial basis a long time ago because we don't have people going into offices. Is there an AI office resurgence and housing resurgence in San Francisco? Yes. But that's not happening in New York. That's not happening in other places. It's fine. But we have a problem there where the people that are keeping the real estate prices up are the ones that have all the wealth and they're moving their money outside of things to hide it into different places. I just think when the corporate stock market can't go up anymore, it will lead to more and more money going towards things that are actually growing revenues and are actually benefiting. And the only place that I can see that won't be disrupted as a market cap basis that is public is the crypto world. I think small entrepreneurs will win inside this world, but they'll be using open source. And open source to me is a major, major positive for crypto. So I'm a big believer that the economy is becoming more digital. And it's becoming digital with AI native businesses and entrepreneurs. And it's becoming less about the companies that won in the past and had moats. Like I said to you, moats will decay, the money will go away, and they're going to go to places that are growing. And I think that's entrepreneurs. And I think it's the digital crypto financial guardrails.
The easiest way to misunderstand money printing is to imagine it as a simple event where a central bank creates money and everyone immediately becomes richer. That's not really how the transmission works. The important question isn't simply how much money gets created, it is where that liquidity eventually travels. When monetary conditions become easier, capital searches for assets that can preserve purchasing power, generate returns, or capture the next wave of economic growth. And that is why every major liquidity cycle can create enormous distortions in asset prices. We saw versions of this after the global financial crisis and again during the pandemic. Trillions in fiscal and monetary support didn't simply sit inside the banking system. They flowed through financial markets, into equities, real estate, commodities, venture capital, and eventually crypto. Asset prices responded because the amount of capital chasing scarce or desirable assets changed dramatically. That doesn't mean every asset rises forever, or that every round of monetary expansion automatically produces a Bitcoin bull market. It means that when the quantity of liquidity changes, the relative attractiveness and valuation of financial assets can change with it. Visser's thesis is that the next decade could involve a collision between AI, debt, monetary expansion, tokenization, and decentralization. AI may initially absorb enormous amounts of capital as companies spend trillions building the infrastructure required for the next technological revolution. But if that investment eventually produces productivity gains, disrupts incumbent companies and changes where economic value is created, capital will begin searching for the next generation of winners. At the same time, tokenization could bring previously illiquid assets onto digital financial rails, while open-source technology gives smaller entrepreneurs tools that were once available primarily to massive corporations. And Bitcoin sits directly inside that transition. If the system manages to avoid monetary expansion, Bitcoin's value proposition remains intact because it offers a scarce, decentralized monetary asset outside the control of any single government. But if the debt burden becomes so large that policymakers increasingly have to prioritize financial stability and lower long-term yields, the liquidity environment could become dramatically more favorable for scarce assets. Either way, the argument for Bitcoin doesn't necessarily disappear. The question is whether the next phase of the monetary system makes that argument even more powerful. If you found this analysis useful, make sure to hit the like button, subscribe to the channel. Share this video with someone who follows Bitcoin and macro markets. Thanks for watching, and I'll see you in the next one.